markets have entered a rare split-screen economy. Headline inflation is creeping higher while wholesale price pressures ease. Central banks are pausing, but markets are already pricing future cuts. Tech megacaps keep levitating on AI euphoria, and oil traders face the paradox of more OPEC plus barrels against softer demand. It is a perfect setting for volatility and for opportunity. Annual CPI accelerated to 2.7% in June from 2.4% in May, topping all forecasts and marking the first back-to-back monthly rise since January. This rise was due to two components: shelter and gasoline, while core CPI ticked up to 2.9% despite tariff filtering into furniture and apparel prices. On the other side of the Atlantic, however, the Eurozone inflation is now back to target at 2%, while core is down to 2.3%, the lowest print in 3 years. On the supply side, US wholesale prices were flat for the month, while annual pace dropped to 2.3%, indicating shrinking margin for producers for now. With inflation still above target and growth is resilient, the Fed is widely expected to leave the fund rate where it is for the July 30th meeting. Futures now imply just a 5% probability of an immediate cut, but a 60% chance in September and 45 basis points of easing priced year-end. Chair Powell's post-meeting press conference will likely be scrutinized for any shift in tone toward tariff-driven price pressures. The U.S. bond market saw some volatility over the past 3 weeks, with the 10-year Treasury yield fluctuating between 4.24% and 4.50%, before settling around 4.35 to 4.37. Yield subsequently declined amid trade deal optimism and foreign demand stabilization. Foreign Treasury demand showed mixed signals, with custodial holdings dropping $17 billion recently despite March's record of $9.05 trillion peak. Investment-grade corporate bond spread tightened dramatically to just 80 basis points over treasuries. That's near historic lows from 1998. This suggests really higher rate of rotation from equities into fixed income amid record high stock valuations. Overall, market remains optimistic, buoyed by AI-fueled tech earnings and liquidity, even as cyclical sectors signal caution, and energy markets are grappling with the paradox of rising supply against softer demand, while corporate America weighs cost inflation versus pricing power.